If you're watching this, there's a good chance it's not for you. It's for your mom or your dad. Maybe a parent just had a health scare. Maybe you're the one who'd get the phone call and the bills if something happened tomorrow. And maybe you started looking into life insurance for them and hit the same wall everyone does. Half the options seemed aimed at 30-year-olds. The other half are those mailers and TV ads your parents already get, and nobody actually tells you what a 75-year-old can realistically qualify for. In the next few minutes, I'll walk you through this in plain English. How to check what your parent may already have, how to find the gap that's actually left, what a parent in their 70s or 80s can really get, who plays which role in a policy, the mistakes families can avoid, and, honestly, the hardest part, how to bring this up with your parent without it feeling like you're planning their funeral. Hi, I'm Paul Helbling. I'm a licensed insurance agent, and on this channel, I explain insurance and family protection decisions in plain English. Now, here's who this video is for. Adult children helping a parent who's roughly 65 or older. If your parent is younger and healthy, some of this still applies, but your options are wider than what I'll focus on here. And what this won't be, I'm not going to name a best company. I'm not going to quote you a magic price. I'm not going to pretend every parent can be covered the same way. So let's get into this. Before you shop for anything, start here, because your parent may actually already have part of this handled. The job isn't to pile on coverage, it's to find the gap. So take an inventory. Look for any life insurance your parent already owns, coverage left over from a former employee or a retiree plan, a prepaid or pre-need arrangement with a funeral home, dedicated savings set aside for this, veterans benefits they may be entitled to, and any other resource earmarked for final expenses. Then, ask 4 honest questions about what you find. Is this coverage enough? Is it permanent? Or will it end at a certain age or when your parent stops paying? Is it still active? Does the family know where it is and how to actually access it? If the answers are clear and the coverage is solid, that's genuinely good news. But if answers are fuzzy, nobody's sure how much, or whether it's still in force, or where the paperwork even is, that uncertainty is itself the signal. It usually means it's time for a policy review and sometimes additional coverage. Hold on to that list. In a minute, we'll measure it against what it actually needs to cover. Now, let's put a number on the goal, because there are really 2 different jobs, and people mix them up constantly. The first is covering final expenses, the funeral, the burial or cremation, the last bills. The second is leaving a larger legacy, replacing income, paying off a mortgage, leaving something to the grandkids. For most parents in their 70s and 80s, it's the first one. And that matters because cover the final bill points to a small policy, which is exactly the kind an older parent can still qualify for. To give you a real anchor, the National Funeral Directors Association's 2023 national median was about $8,300 for a funeral with viewing and burial, and about $6,280 for a funeral with cremation. Those are national medians. Your actual cost depends on where you live and the services you choose. Whatever that number is for your family, that's your target. Now subtract what you found in your inventory. What's left? If anything, it's the gap. That gap is the only thing you're actually shopping for. Getting this right up front is what keeps you from the 2 opposite mistakes: buying far more than you need, or buying nothing because a big quote scared you off. At older ages, term life insurance, the big, cheap, temporary kind advertised to younger people, is usually either very expensive or simply not offered, because term is built to cover your working years. There are exceptions, and if your parent is younger and healthy, it can still be worth a look. But for many parents in their 70s and 80s who need permanent coverage for final expenses, a small whole life policy, often called final expense or burial insurance, is usually the most practical place to start. It's built to stay in force for life and pay out a modest amount. That doesn't make it automatically right for every parent, but for this specific job, it's usually where a sensible search begins. Within that, there are two flavors, and knowing the differences can save your family real money. First, simplified issue. Your parent answers a short list of health questions, no medical exam, just yes or no questions. It typically costs less per dollar of coverage, and the full benefit is usually available right away. The catch? Because there are health questions, your parent can be declined. Second, guaranteed issue. No health questions at all. Within the age limits, your parent typically can't be turned down, which is why this exists for people with serious health conditions. But you pay for that certainty two ways. It usually costs more per dollar of coverage, and it almost always comes with a waiting period, sometimes called a graded benefit, and terms vary by policy. Here's what a waiting period usually means, because it surprises people. During that early window, often the first 2 policy years, if your parent passes away from natural causes, the policy typically returns the premiums paid plus some interest rather than the full death benefit. Accidental death is often covered in full from day one, depending on the policy. After the waiting period ends, the full death benefit is available under the policy terms. Now, the exact rules will vary by carrier, state, and policy. So the honest rule of thumb, if your parent can answer the health questions and qualify for simplified issue, that's usually the better value. Guaranteed issue is a real solution. It's not a scam, but it's the option you choose because you have to, not because it's the cheapest. Before anything else, one thing a lot of people get wrong: you cannot quietly take out a policy on a competent parent behind their back. It just doesn't work that way. And that's a good thing. Your parent has to know about the application, take part in it, answer any health questions honestly themselves, and provide the required consent and signatures. So this is never something you do to a parent. It's something you do with them. Once your parent is on board, it helps to understand a few roles in a policy, and they don't all have to be the same person. The insured is your parent, the life the policy is built around. The owner is whoever controls the policy. The beneficiary is whoever receives the death benefit. Separate from all that is simply who pays the premium. That can be your parent, the owner, you, or another permitted person. Paying the premium isn't a formal contractual role the way the others are. It's just whose money keeps the policy going. In some situations, an adult child can own the policy and pay the premium, but that's subject to your parents' consent, insurable interest requirements, the carrier's rules, and your state's laws. It's doable in the right circumstances. It's just not automatic. A quick word on the beneficiary, because it's where good intentions go sideways. Choose it deliberately based on your parents' wishes and the family's plan for handling the final expenses, not by default. And understand this: the death benefit is paid to the named beneficiary. It's not automatically earmarked for the funeral. Whoever is named receives the money and decides how it's used. So the person you name and the family's understanding of the plan needs to line up, or the money can end up somewhere no one intended. Now, let me flag the 5 issues I see most often. None are exotic. They're just the preventable ones. 1. Putting it off indefinitely. There's no reason to panic here, but there's a reason not to leave this on the someday pile. Age affects the pricing, and a new health condition can reduce the choices available. Looking before a crisis simply preserves more options. 2. Buying blind off a mailer or TV ad. Those aren't automatically bad products, but a piece of mail is simply designed to get one signature, not compare your parents' options. Grabbing the first thing that arrives is how families end up with the wrong fit. 3. Overbuying. Remember the gap we identified earlier? If the job is the final bill, you don't need a six-figure policy. Right size beats bigger. 4. Letting a policy lapse. A missed payment can quietly end coverage that protects no one once it's gone. Make sure someone is keeping an eye on it. 5. Nobody knowing it exists. A policy your family can't find might as well not be there. Where the paperwork lives and who to call matters as much as the policy itself. Okay, the real reason this is hard usually isn't the insurance. It's the conversation. Nobody wants to sit across from their mom and bring up her funeral. So don't frame it that way. You're not planning her death. You're making sure that if anything ever happens, she's taken care of and the family isn't scrambling. A few things that make this go better. Lead with them, not the money. Mom, I want to make sure that if anything ever happens, you're taken care of and none of us are stuck guessing. Can we talk about how that's set up? Do it early and calm, over a coffee on an ordinary Tuesday, not in a hospital hallway. Bring the siblings in. The fastest way to turn this into a fight is for one adult child to handle it in secret. Make it about a decision, not a sale. You're figuring out together whether there's a gap and how big it is, nothing more. So here's the whole thing as a simple process you can actually follow. First, check what your parent already has. Second, figure out whether there's a real gap between that and what final expenses would actually cost. Third, include your parent in the decision. This is done with them, never around them. Fourth, compare the realistic options, usually simplified issue if they can answer the health questions, guaranteed issue if they can't. Fifth, structure the policy correctly. The right owner, the right beneficiary, and a clear plan for who pays. 6. Keep the policy and the records organized so the family can actually find and use it. And finally, 7th, take action before a crisis narrows the choices. There's no reason to panic about any of this, but looking early, while your parent still has options, is simply the kind thing to do for everyone involved. If this made a confusing thing clearer, hit like. It genuinely helps other families find this. And subscribe for more plain English videos about insurance, final expenses, and protecting your family. And if you'd rather not sort through your parents' options alone, there's a link below to book a free, no-obligation conversation. Here's what that actually looks like. I'll help you review what your parent already has, identify any gap that's left, and walk through the options they're likely to qualify for. We'll compare simplified issue and guaranteed issue for their situation, right-size the amount so you're not over or under buying, and get the ownership, premium payments, beneficiary choice, and record keeping set up properly. And if the coverage your parent already has is sufficient, I'll tell you that too. Take care of the people who took care of you. I'll see you in the next one.